Well, everyone, it's been fun while it lasted. As of October 18th, the United States government will no longer have any money to pay its bills. That's according to Treasury Secretary Janet Yellen. That means no more money for Social Security recipients, no more money for soldiers, no more money for really anything. The government is going to have to just stop paying its bills. If you're wondering what I'm talking about, of course, the debt ceiling and the failure of the Congress to actually work together and raise the debt ceiling, causing a default on government debt. That is the fear, and if Congress does not act in the next few weeks, that is a scenario we could encounter. All sorts of terrible things will happen if the United States defaults on its debt. That is, it doesn't make its payments on its debt it's already occurred because it didn't raise the debt ceiling. Things like the economy collapsing, the stock market falling, housing prices crashing, people being unemployed, and the economic disaster that we have never ever seen before. Because the United States government has never ever defaulted on its debt before. And if the United States defaulted on its debt, not only would we have serious issues here, the entire global economy could collapse with it. And that's just not me being hyperbolic. If you look at the stock market in the last couple of days, the stock market has fallen. The bond market has been highly volatile, and people, very intelligent people, are saying that this is extremely serious. And to be very clear, raising the debt ceiling or the failure to raise the debt ceiling and the corresponding default on government debt is entirely different from a government shutdown, which is bad, but nowhere remotely close to the failure of the United States to pay its debts. Well, if a government shutdown is like stubbing your toe, well, a government default on its debt is more like having your entire leg mauled off by a crocodile, along with your entire family. That was probably a little too dark, but you get the point. It is a huge disaster, and we're going to be talking about all of that in this video, including the difference between a government shutdown and the failure to raise the debt ceiling, what is going on right now in Congress to solve this issue, what risks are actually out there for Congress not solving the issue, what is likely to occur, and of course, all of this implication as it relates to you and your money. So before we jump into it, my name is Kevin Conway. I make personal finance videos all the time. Please like this video. It helps get the word out there. It really helps the channel. And comment below with any questions or comments that you have, any thoughts you have, if you think the United States will default on its debt, or you think this is just a big house of cards and this was always meant to happen in the future. Let me know what you think in the comments below. And don't forget to subscribe if you're not already. If you are a subscriber, thanks so much. Now let's just jump right into it. First off, let's describe the difference between a government shutdown and the failure to raise the debt ceiling and corresponding government default on its debt. Well, a government shutdown is bad, but really not that bad. A government shutdown simply means that Congress is not going to appropriate money to certain programs in the future. It's a forward-looking thing. So if the government goes into a shutdown mode, it actually still pays its bills to its Social Security recipients or any of the programs that are already in motion. It is only the programs in the future, the discretionary programs, that actually get hurt. By and large, if you're a federal worker and you're a non-essential worker in the federal government, so say you work for the Department of Transportation, Department of Commerce, whatever it may be, you will be furloughed, meaning you're not going to get paid and you're not going to work right now, but you will receive back pay once the government reopens again. The last government shutdown we had was just a few years ago, and it lasted a record 35 days. Now, 35 days is a long time if you're a government worker and you have a mortgage to pay and bills to pay, but 35 days is really not that much time, all things considered, when you look at the difference in the government defaulting on its debt versus a government shutting down and the big consequences of both of those. By and large, a government shutdown does not really affect people on a day-to-day basis unless they are employed by the federal government or interact with the federal government in a capacity that is the non-essential part of the federal government. By contrast, the debt ceiling and the default of the government debt has implications for literally everybody in our country and every country abroad. As opposed to a government shutdown, which is the failure of Congress to appropriate money for future spending, the debt ceiling is simply a legal limit on how much debt the United States can borrow to pay for its obligations Congress already set up into place. In other words, instead of it being a forward-looking financial thing, it is a backwards-looking financial thing. Basically, Congress passes bills, whether it be the COVID relief bill or Social Security many decades ago, and it has obligations to pay those things. Well, largely it pays it through taxation and collection of taxes, and of course, deficit spending, that is, borrowing money from people who are willing to lend it to the United States government. The debt ceiling encompasses all United States debt, every single piece of federal United States debt, including all the debt incurred for the payments of basically everything. So if we don't raise the debt ceiling and we're not collecting enough money to make our obligations, well then payments to Social Security holders, Medicare recipients, people who are soldiers, people who work in the federal government, all of that grinds to a halt because the United States is legally barred from issuing new debt, legally barred from borrowing new money up to a certain point. That is the ceiling on debt, the debt ceiling, if you will. Now, the reason you've probably not heard much about the debt ceiling is really because the United States has never gotten this close to not raising the debt ceiling. The debt ceiling has always been something that Congress has worked in a bipartisan manner to actually increase. That is, Republicans and Democrats both had an incentive to keep the debt ceiling raised or suspended, depending on what time period it was, in order to fund what Congress has already said they are going to fund. Now, why is it occurring right now? Why are you hearing about the debt ceiling today? Well, it's basically for two reasons. One, Janet Yellen, the Treasury Secretary, said that the debt ceiling needs to be raised. Otherwise, as of October 18th, the United States will literally not have enough money to make its obligations, and it'll miss its payments on its debt, something that'll have catastrophic ramifications. And secondly, 2 years ago, Congress actually suspended the debt ceiling until August 1st of 2021. Now, why did they do that? There's a variety of reasons why, but suspending the debt ceiling is essentially the same thing as raising the debt ceiling to a certain point. If you suspend the debt ceiling, here's the calculation. Take whatever debt was owed at the time for the federal government at the time the debt ceiling was suspended, and add on any corresponding debt for the intervening years from the time you suspended the debt ceiling until the time the debt ceiling was reinstated, which was August 1st of 2021. At the time the debt ceiling was suspended 2 years ago, the federal government had $22 trillion of debt, and as of August 1st of 2021, we had $28.5 trillion of debt. So $28.5 trillion became the new debt ceiling, and it'll take an act of Congress to raise the debt ceiling from 28.5 to some number greater than 28.5, allowing Congress to spend money on things that is already appropriated, and of course, spend money on future endeavors. To be very clear, raising the debt ceiling simply allows Congress to have the option of spending money up to that certain limit. It's essentially just a massive credit card limit. Let's say, for example, you have a credit card and it has a $500 limit on it. Well, you only could spend on that credit card up to $500. If you raise that credit limit on your credit card to $1,000, well, all of a sudden you could spend up to $1,000. You don't need to, but you have the option to. So if you wanted, you could. Of course, you have to pay it back in the future, but that is to be determined at a later date. You need to know if you could spend more money. That is essentially what the debt ceiling is in relation to the United States and its spending of money. So this brings us to, why is this so partisan? Why can't Republicans and Democrats just get together and raise the debt ceiling? Well, like everything, things are incredibly partisan at this particular juncture. There's a few things going on, but here's essentially what it is. The Republicans are saying, look, Democrats have a majority in the House and the Senate. If they wanted, they could use reconciliation to pass the raising of the debt ceiling along party lines entirely with all Democratic support, and they wouldn't need a single Republican vote to do so. Democrats, by contrast, say, look, Republicans should join in, do this. It's always been a bipartisan matter. It has never been a partisan matter to raise the debt ceiling. It's to pay for things we've already spent money on, and of course, give us room to spend money in the future. Republicans, by contrast, say Democrats are trying to pass a $1 trillion infrastructure bill, which has bipartisan support, and a $3.5 trillion social infrastructure bill, which has no Republican support. And earlier this year, they passed a $1.9 trillion COVID relief bill with no Republican support. In other words, the Democrats are, in the Republicans' eyes, blowing money left and right. They should be responsible for raising the debt ceiling because they are responsible for all of that spending in the first place, and they should have to face the voters. Democrats' counterpoint to Republicans is that, well, number one, the spending has always been with Republicans and Democrats doing a whole lot of it each. Back when President Trump was around, the Republicans and the Democrats passed several COVID relief bills in the order of trillions of dollars. So, of course, the Republicans are in part responsible for this debt. But more importantly, the Democrats won't have the time to actually pass this debt ceiling raising via reconciliation in time for October 18th. Reconciliation is a very complex process, and it's very unclear if they can get it done in time for October 18th. And if they can't, well, then the government will default on its debt, at least for that short period of time. In short, it's a complete mess, and both sides are blaming each other, and both sides think that they will benefit politically from what is currently going on. The Republicans are also using this as leverage against the Democrats for getting the Democrats to drop their spending bills of $3.5 trillion. It's basically a game of chicken at this point, with everybody else, all of you and me, sitting around and waiting to see what the outcome is and hoping that the United States doesn't default on its debt. Furthermore, it should be noted that even if the Democrats wanted to pass this debt ceiling with reconciliation, they actually wouldn't really want to do so because they might want to save reconciliation for the $3.5 trillion infrastructure bill, social infrastructure bill that they're trying to pass now. You only can use reconciliation a few times every fiscal year. It's essentially once or twice, it really depends, and they want to save that for the social infrastructure bill. That's kind of the side point, the kind of background story behind this entire ordeal as well. So how is this going to affect markets? Well, essentially, as interest rates increase, asset values decrease. There's a variety of reasons why, but that is the essential correlation. So if interest rates increase, everything else becomes more expensive. If you have a home, or if you're looking to purchase a home and interest rates are 3% for your mortgage versus 7%, well, you could buy a lot more home if they're 3% versus 7%. So you are not going to buy as big a home or even a home at all if interest rates are 7%. So that just shows you how interest rates impact asset values. Less people purchasing homes means home values will go down. So that is one example. Another example, of course, is something like student loans. If your student loan rates go up by, twofold, all of a sudden you have less money every month because you have to make those payments, which means you have less money to spend on goods and services. You can see how interest rates rising decreases economic activity and will lead to a recession. And this isn't just me speaking. The bond markets have actually spoken as of late. Usually, bonds that mature in a month's time are going to have a much lower yield on them than bonds that mature in 10 years' time. The reason is because people who actually borrow money for 1 month are less risky than those who borrow money for 10 years, because a lot more can happen in 10 years than in 1 month. Inflation can go up. I could just not pay you over 10 years. I could just do whatever I want. So interest rates tend to be higher on longer dated debt maturities. But as of recent, the shorter dated debt maturities have actually increased in yield versus the typical fashion, which is that they're the lowest of all of the continuum of maturities and corresponding yields. The reason they've increased is because bondholders, people are fearful that the government will not actually make its payment in a month or 2 months on the amount of money that is outstanding for those bondholders. Therefore, the interest rates should go up, the bond prices go down, interest rates go up in the shorter term maturities. And the longer term ones are actually, interestingly, still low, and it's because they think that eventually the government will actually get back on track here and actually pay its bills. But in the short run, there's a big risk. And that right there shows you that a lot of people, a lot of smart money, trillions of dollars out there, are all worried about the debt ceiling. So let me know what you guys think in the comments below. I really want to hear your opinion on this matter. Right now, it is really fearful, and we're just all going to have to sit around and see what happens. So see you next time, and of course, please give a like to this video and share it with anybody that you think might want to see it. Thanks so much.